Welcome to this course on an introduction to project finance for renewable energy projects. In this course we look at the principles behind how projects such as wind farms, solar farms, hydroelectric power plants and so on are built and financed. These principles are not just reserved for renewable energy projects, they hold true for any project which involves building and operating large infrastructure. However, in this course we will concentrate on project finance for renewable energy projects only. So to start with, there needs to be a concept, and that concept can be quite simple while also being all-encompassing. For example, the concept could be something like this. Assuming we have planning permission and all the technical aspects are catered for and are feasible, we wish to borrow money to build a renewable energy asset that generates electricity. We then wish to sell this electricity to generate a revenue. We use that revenue to operate and maintain the asset while also paying taxes on any profits, paying back loans and interest, and then finally, if we have any money left over, which we should, paying back money to the private lenders, otherwise known as equity investors or equity sponsors. So what is project finance? If you go on Google and you type in project finance, you may find something from Investopedia which reads as the following. Project finance is the funding of long-term infrastructure, industrial projects and public services using non-recourse or limited recourse financial structure. The debt and equity used to finance the project are paid back from the cash flow generated by the project. Project financing is a loan structure that relies primarily on the project's cash flow for repayment, with the project's assets, rights and interests held as secondary collateral. And this is a perfectly adequate explanation if you were given an example of project finance. But I'm sure this leaves the door open for further questions and clarification, doesn't it? We can take the concept of project finance or a project and draw it out visually as a diagram. Here we have the main aspects of a project with arrows that denote money flowing in to the project and money flowing out of the project. Okay, so flowing outwards, flowing inwards. Positive showing cash flowing in, so I've given this a positive symbol here. Positive with cash flowing in, and then negative with as cash flowing out, so negative cash flow out of the project. Notice that all the cash flows move through one central point, and this central point is the SPV or Special Purpose Vehicle. The role of the SPV is to coordinate the project and act as a conduit for cash flows. These projects involve building real infrastructure on real land for many years. And so the first thing we may want to consider as an example is the land in which we want to place the asset upon. I use the term generator and asset interchangeably throughout the course. We could purchase some land or we could rent some land, but the point I really want to make here is that who makes these decisions? This is the role of the Special Purpose Vehicle, SPV. An SPV is nothing more than a legal entity that allows the project to happen. In the UK, a typical type of special purpose vehicle is a limited company, and as the name suggests, has a limited liability, which ties into the definition we saw earlier. It is formed of people who are called directors that make decisions that need to be made, such as identifying land, applying for planning permission on that land, coming up with detailed designs by engaging consultants, finding and negotiating with contractors to build and operate the project, raising funds from lenders, paying debt and dividends, receiving revenue, and producing a financial model to ensure that all of this works seamlessly, which is ultimately the aim of this course. So let's have a look at some of these individually. Let's have a look at capital expenditure, which is here. This is the initial cost of the generating equipment, groundworks, grid connection, and so on and so forth. Capital expenditure might be very large, running into millions or even billions, depending on the size of the project. We're probably talking millions in terms of our projects, not billions. So with all that money being paid out, we'd better make sure we have a sound method or plan of getting some money back into the project over its entire lifetime, which could be 20 to 25 years. for these kinds of assets, solar and wind. This is called revenue, and that is the money that flows back into the project from electricity sales to a company that wishes to contract with the SPV to buy your electricity. It's certainly not possible to assume that your generator is going to run for 25 years without any maintenance, repairs and other interventions. And some of the revenue that comes in has to be spent on maintaining the asset, ensuring it produces an adequate amount of yield, or adequate amount of electricity year in, year out. And also, along with that, paying some land rent, insurance, and a myriad of other bills and payments that are surely going to crop up over the years. These are known as operating expenses, and we'll go through each of these in a fair amount of detail during the course. Returning to the subject of yield. Yield is a term I am given to how much energy the generator produces each year in kilowatt hours, megawatt hours, or even gigawatt hours, depending on its size, or depending on how you wish to express it. We can calculate this with a certain level of confidence, and it's important to calculate this as accurately as possible. So during this course, we'll discover how we might do this using some free software that's available online, while also, very importantly, recognizing the limitations of this. And it's really, really important to recognize the limitations and state them and be open and honest with them. As already stated, these projects cost a lot of money. And consider a scenario where you just don't have a lot of money. Okay, you don't have the money to fund this project. You also don't have the technical knowledge to build and operate this generator. Couple this with a lack of proven track record of running such a project, and it does not seem possible to achieve. However, you might be surprised to know that it is possible to achieve. And this is where the principles of project finance come in to help. Let's go ahead with wanting to build this wind turbine or solar farm. The concept has been established. A group of people want to build a wind turbine or solar farm and sell the electricity they produce to another company who wants to buy that electricity. They want to build this asset to contribute more renewable energy into the national grid, and crucially, they need to make money. Even if this is not their primary aim, the institutions lending the money certainly care greatly about getting a positive return on their investment. And so even if it is not the primary purpose to generate wealth from the project, it is certainly within everyone's interest to do so to an adequate level, and that's quite important, to an adequate level. In order to make this happen, they need to design, purchase and install generating equipment. Once the turbine or generator or asset is built, it needs to run smoothly, which usually means getting another company to make sure this happens. In order to receive an income from the turbine, the electricity must be sold, and this is usually in the form of a power purchase agreement where an electricity company agrees to buy electricity from your turbine for an agreed price for a certain number of years. All of these activities involve the directors of the SPV to make contracts with the various parties involved. Let's assume this wind turbine or solar farm or any asset is going to cost £1 million. Where do we get this money from? Since we have already assumed that the company does not have this kind of money? This is where financing comes in. Money for these projects usually comes from two sources, one being the bank in the form of debt, otherwise known as loans or senior loans or junior loans, and the other from sponsors in the form of equity. In order to convince the bank to loan the company money to build this project, they must endure a high level of scrutiny, and they will require a high level of scrutiny. They will want to know that there are good contracts in place between yourself and all the parties involved, all the ones we've talked about, and this is to mitigate the risk of project failure. We have already mentioned some of these contracts, and we will go through more of them during the course. During this course, we will explore some metrics that loan lenders will often use or will use to scrutinise the project. And we're going to look at two in particular, albeit there are more. We're going to look at the debt service cover ratio and the cash flow available for debt service. So debt service cover ratio, cash flow available for debt service, CFADs. In assessing the project's viability, lenders examine the technical feasibility, financial feasibility and creditworthiness of the project, which is the capacity of the project to service the debt considering a certain degree of downside in the cash flows available. The due diligence process ultimately decides whether to advance a loan or not. You may also raise funds from equity sponsors, and this is quite different. Based on having a solid plan, the company can raise money from investors. Typically, the project pays investors dividends. That's a minus there. So funds is a positive, that's money in. Dividends is negative, that's money out of the project each year. But isn't obliged by law to do so. Investors benefit if the project is successful, and so it's within their interest to only invest in the project that's destined to be successful. Equity investors tend to use different metrics to establish the viability of the project, and during this course we will learn how to calculate the equity internal rate of return, or equity IRR. IRR is internal rate of return is abbreviated to IRR. Equity sponsors will use this figure to decide if they wish to invest in the project, and along with other figures as well, but that's the one we're going to use. However, before approaching funders, the company needs to know that the project works on this most basic level. That's taking all of revenues, operational expenses and capital expenditure to find the cash flows in the absence of any finance. To do this, we typically determine a metric or metrics known as the project IRR, internal rate of return, and the net present value. We're going to dedicate a fair amount of time in the course into understanding what these terms mean and how to calculate them. This may seem like a strange concept so at this point, however by the end of the course it should become quite understandable why we do this. On that subject, let's explore the tools at our disposal for calculating these metrics. Typically, a project finance model is created using a standard spreadsheet, and there's one shown here, Microsoft Excel. We've chosen Microsoft Excel for this course, but you may use any spreadsheet software out there. There's plenty available. Here's an example of a typical project finance model created for this course here. We've created this model for the course. And this is the one you're going to be creating or using. You should start to recognize the aforementioned metrics here. We've got project IRR, net present value, DSCR and equity IRR there. Project finance models come in many different forms and normally reflect the personal preferences of the person or company making them, or how much time they've got to make them as well. Nevertheless, there are certain best practices that should be observed, and we will cover most of these during the course, probably not all of them, but most of them. For instance, we will learn how to set up a really good project timeline. We're going to learn some helpful shortcut keys. We're going to learn how to set up the sheet for accounting and explore some helpful formulas as well, which you can take away and use in your own models. Crucially, we will also learn the limitations of our model. It should be emphasised that the model we intend to create is extremely basic and contains many limitations and caveats, and we will go through them all. Well, we will go through a lot of them. Inevitably, we will miss out some things. Having said that, well, given that, I can now say that this is for educational purposes only and by no means intended to be used outside this course. I'm referring to this model here. What will we cover during this course? And as a summary, in this course, we will use a common spreadsheet to produce a financial model that tells us some common metrics used to help us decide if a renewable energy project works financially or not. We will consider the project from three aspects or points of view, one being from the company's point of view, determine if the project works pre-finance, so that's our EBITDA, net present value, project IRR, then from the loan lender's point of view, and finally from the equity sponsor's point of view. They're all going to want to see things from their own different points of view, but eventually they will all come together within the financial model, and each will depend on the other. And given the interactions with each other, we will come to a conclusion. We will also learn how to use free online tools to calculate the revenue. So that's PVGIS for solar, Renewables Ninja for solar and wind, and Global Wind Atlas as well, and Open Solar as well. I like that part of the course. It's more my area, looking at the technical aspects of renewable energy generation. We will, quite nicely actually, we'll go through an example of how to calculate wind yield from wind speed data and power curves, which is a nice little section there as well. We'll also compare the model we make against a well-established financial model provided freely from the Welsh Government Energy Service. So this is a screenshot of that, and this is a professional model created and is available on the internet, so we can compare our model to their model. By the end of this course, you should be able to understand and calculate the following. You should know about cash flows. We'll be able to calculate the EBITDA. I'm not going to ruin it for you. We'll learn that during the course. We'll know about construction expenses, the differences between construction and operation expenses, and how we model them. We're going to look at revenue from solar and wind yield calculations. We'll touch upon discounted cash flow analysis, net present value, which is basically discounted cash flow analysis, project IRR, depreciation and capitalization. We'll have a look at that. We'll have a little look at tax as well. We'll have a look at debt, fixed principal and annuity repayments or payments. We'll talk about equity. We'll talk about cash flow available for debt service. We'll talk about debt service cover ratio. We will look at equity IRR, and we'll have a look at Excel techniques and shortcuts. We'll have a look at spreadsheet formatting and best practices, plus much, much more that I've failed to mention here. Prior knowledge of using a spreadsheet is definitely advantageous, as there is not really enough time in this course to explain how to use Microsoft Excel fundamentally. However, we will build up the model using examples in a step-by-step manner, finally building up to a fully usable model to be used in this course. We will then use the results to establish an understanding of whether a project works financially or not by applying it to a few fictitious examples. I've tried to make them as realistic as I could, but, they are fictitious. We can also use the same information to compare various projects against one another using a common set of rules. The assessment for this course is a series of short questions after every section, followed by a written assessment in the form of a short report. I've tried to keep this course as true to real-world scenarios as possible, and so this final assessment is meant to reflect this, so see how it goes. So I hope that's a good enough introduction and reflects what is on the course, and I hope you've become inspired to actually want to do the course. That's the main thing. Okay, enjoy.